Hello and welcome to this week's episode of Nucleus Investment Insights. Today we ask the question, what happens when a nascent housing boom meets a mortgage cliff? We've known for a long time now that a fixed rate mortgage cliff is now meeting the RBA's tide of increasing interest rates and the headwinds that's going to create for consumers and the property sector. Despite this, there are indicators showing that the property market may have bottomed, and there are many strong drivers for a bullish 2024. The immigration floodgates are open, but yesterday, Star Entertainment announced 500 job cuts, along with many other companies laying off staff and bankruptcies increasing. How are these seemingly competing forces going to play out? Join us today to find out. Today, as always, we have Damien Klassen, Nucleus Wealth founder and Chief Investment Officer. Damo, welcome.
Thanks, Sam.
And today we'd like to welcome back Leith van Onselen, Nucleus Wealth's straight-talking Chief Economist. Leith, g'day.
Yeah, g'day, guys. G'day, Sam.
My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. Just a reminder, the information in this podcast is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact, and you can book a call with me to have a no obligation chat. We are live every Thursday at 12:30 Sydney, Melbourne time. So jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind and we'll do our best to answer them during the show. You can also follow us on your preferred podcast platform as our show is available on all the majors. So that's all the formalities. Damo, I'll hand it over to you to get the ball rolling.
Yeah, thanks, Sam. So it's been a little while since we've done a take on housing. So given we've started to see house prices rise in a few places. Leith's been busy writing some stuff on the MB site, and I noticed, just this morning there was a whole roundup of economists in the AFR all talking about how they were basically upgrading their views from a 20% fall in prices to generally somewhere between like about a 10 and a 15%, I think, depending upon how bearish or whatever they are. And so we wanted to sort of jump into and talk about some of these themes and where they're leading. So I guess without no further ado, I'll hand over to Leith and you can talk about what we're seeing in terms of house prices at the moment.
Yeah, thanks, Damo. Look, it has been a pretty remarkable rebound that almost nobody predicted, except for, I've got to give the guy a hat tip, Stephen Koukoulas, the Kook. The Kook did the great housing debate with Chris Joy, I don't know, about a year ago, and the Kook was tipping sort of a 7% peak to trough fall, and then he upgraded to 10%. And I must admit, pretty much everyone thought he was crazy. And here we are. It does look like the housing market, has more than likely bottomed, although there are still some headwinds. And if you go by the CoreLogic's daily index, it bottomed on the 7th of February. And since that, the prices across the 5 major capital cities, which is what the index measures, have risen by 1.4%. And this has been driven by Sydney, where prices have rebounded by 2.6%. But across the 3 major capital city markets, Sydney, Melbourne and Brisbane, prices have already bottomed and they're now starting to rise. And this has been sort of matched by, quite pretty solid rebounds in auction clearance rates across Sydney and Melbourne. Auction clearances are only really relevant in Sydney and Melbourne because they're markets that actually have a lot of auctions, whereas the rest of the country, auctions are pretty rare. But across Sydney, the auction rebound's been very, very strong. And across Melbourne, the auction clearance rates have also rebounded. So and auctions typically lead prices. So when you get rebounding auction clearance rates, it usually means that prices are rebounding, and both markets are showing pretty strong growth. And in fact, last weekend, both Sydney and Melbourne's auction markets recorded their strongest results since early last year, before the RBA started hiking rates. So that's sort of a sign that the housing market has bottomed and the prices starting to rise. We've also had, interest rates, variable rates, pretty much close to their peak. They might go slightly higher if the RBA does another rate hike, but they're pretty much peaked. But fixed rates have already have fallen about 3 months ago, so there's been a bit of relief on the mortgage side, and also finance commitments. So new finance commitments are obviously a very strong indicator for house prices, and those actually bottomed out a few months ago, and now the growth in finance commitments has turned the corner as well. So that's also signaling that prices will prices are rebounding. And finally, the Westpac's house price expectations index, which has a pretty strong correlation with house prices, has also been rebounding in the last couple of months. So, the sort of short-term momentum indicators, I guess that's what you can call them, they're all showing that the market's turning around, and that's obviously been reflected in CoreLogic's house price index and also PropTrack's monthly index. So, it does look like we're at the bottom, but there's still a few headwinds in that we've got the fixed rate mortgage cliff. So this quarter, so April, May, June, we're going to see about 220,000 fixed rate mortgages across the big four banks, a little bit higher if you include everyone else, move from ultra cheap pandemic rates of about 2% up to about, above 5%. And that's up from that 70,000 in the previous quarter. And then the following two quarters after that, so the September and December quarters, we get about another 400,000 collectively. So we've got three quarters of, say, this fixed rate mortgage cliff, where huge numbers of borrowers who borrowed during the pandemic at ultra cheap rates, a lot of them are first home buyers, etc., are going to suddenly reset to rates that are double or possibly triple their current levels. So that's still a headwind. That the risk there is that these borrowers could be in a negative cash flow situation. They're forced to sell, and then they flood the market with distressed sales. So that is still a possibility, which could lead to another leg down. But if I had to balance it out, I think we will eke out a bit of growth this year, but all signs next year are pointing to a boom. I guess we'll talk about that a bit later, I suppose, unless you want me to go into it now.
No. Let's. I wanted to dig into some of these issues. So just in a bit more detail, so that we can sort of see where the. I guess where there's. To me, there's a lot of the stuff that, as you said, indicating there's a boom coming, subject to a whole bunch of other factors that are going on. And so I guess what I would do is talk through some of the more detail about what we're seeing in terms on the ground, and then flip that back around to where things could go. Because one of the ones I did want to focus in on is the mortgage rates. And there's two things I wanted to highlight. One is we've got these record discounts on at the moment for what you call qualified mortgage holders. So this is the difference between, I've got a chart up just sort of showing the difference between the standard variable rate and the discounted standard variable rate. And traditionally that was sort of somewhere between about half and 75 basis points, so 0.5% and 0.75. And it was basically that way for, these haven't been around that long, but RBA started tracking them sort of in the early 2000s. So for sort of 15 years, that's where it was. And then basically as the pandemic hit, these discounts started to grow, and now they're basically pretty close to 3 times bigger than what they've been in the past. And so certainly like the average discount at the moment is somewhere between 1.5 and 1.75. And you hear lots of stories of people with it much larger discounts than that. And so in a way, I just wanted to highlight that there's this growing disconnect, and we'll get into that mortgage cliff in a minute. But it's the part about saying if you have lots of space, or you've got a reasonable income and all those types of things, then the mortgage rates you're paying are much lower than these standard rates, and so things aren't as bad if you can handle it. The problem is the people that are most at risk from this mortgage cliff, they're the ones who aren't going to get these discounts, and so it's this part about the average versus the versus the actual marginal one, which is going to be important, and we'll move into that a little bit later. And the other one on the interest rates I wanted to highlight is that. What I guess it's this part about what is the actual what mortgage rate should you use when you use affordability stats. And so I run a bunch of affordability stats on our property calculator and a whole bunch of other areas that I use. And you're always facing this issue of what rate do I actually use to try and represent what's going on. And the rate which I'd sort of eventually settled on was basically saying, well, if I take the discounted variable mortgage rate and then I look at the 3-year rate that's available, and I just say, well, for a new home buyer coming on or a existing person who's refinancing or upgrading or whatever, if I just took the minimum of those two, so that, if that's sort of a rough guide as to what this a new home buyer or an upgrader is facing in terms of mortgages, then those rates are actually already falling. And so we had a bit of a fall late last year as these mortgage discounts got even bigger. And the issue where we are now is that the standard variable rate is now above the 3-year fixed. And in the most recent weeks, we've had a number of reasonable sized cuts in terms of the 3-year fixed rates. And so I know this isn't the rate that, everyone is facing out there, but if this is sort of the rate for a new person turning up to a bank looking to get this refinance. And so, arguably rates sort of pretty much peaked, 3 or 4 months ago. And they've started falling now, which actually sort of fits a little bit with some of those pricing as well. Basically when the prices started to bottom out was when that sort of rate, the minimum of those two stopped rising. And as they've started to fall, arguably there's that's potentially some of the impetus for what we've seen in terms of that strength. So yes, that's on the mortgage rate sides. The other stuff we sort of need to talk about, Leith, obviously is immigration.
Yes, red hot.
So I'll let you jump across to that.
Yeah, so basically, so we all know, everyone who's probably watching this has read about the rental crisis. So effectively, Australia's rental vacancy rate's the lowest it's been in pretty much recorded history, and we've got rents rising at double-digit rates across all the major capital cities. Actually, well above sort of the mid-teens across Sydney, Melbourne, Adelaide, Brisbane, Perth, and basically what we've seen is we've seen the biggest ramp up in immigration in Australia's history in number terms post-pandemic. So in 2020, the calendar year 2022, we had nearly 400,000 net overseas migrants arrive in Australia, and that pushed our population growth up to about 480,000, which has never before been that high. And what that obviously means is it's tightened the rental market. The rental market tightened over the pandemic when you had we had a decent increase in number of people per houses because people needed home offices, etc. So effectively there was less rental stock per person, per family. Now we're getting a huge rush of people into the country, which has tightened the rental market. And also some of those people who come are going to want to buy as well, but if they can afford to. And also those who are renting, faced with double-digit rents, some of them don't want to rent anymore because it's not a great experience, and they're trying to buy as well. So we've got this. And if you're a property investor and you've seen rents skyrocketing, you think it's going to continue, well, then there's at the margin you want to. There's more impetus to buy as well. So the whole mass immigration rental crisis nexus is also helping to support prices as well, although it's obviously having a bigger impact on the rental market. There is one downside to that, though. The rents make up 6% of the consumer price index, and we're seeing asking rents have rocketed, and the rents that the ABS measures, which are overall rents, follow that. So we're likely to see rents push up Australia's inflation, which could also lead to the RBA keeping rates higher for longer. So there is also that also creates a headwind as well as a tailwind, but more of a headwind.
Well, so that's an argument for the RBA keeping rates higher for longer.
Yeah.
But as I said, 6% of the 6% of the inflation, the CPI, is it?
Yeah, that's right. Yeah, 6% just rents, but then it's having an impact on obviously construction prices, etc. So that's also that. So construction, the housing dwellings, I guess, if you count construction and rents as the biggest component of the CPI, but rents alone is 6%.
Yeah, and see the different countries. So the US, for example, has like an owner's effective sort of rent, and so I think it's almost 40%. Maybe it's over 30 anyway. The impact of the rent,
the owner occupied imputed rent. Yeah.
And so I guess that's just to highlight that there's a difference in the way different countries calculate CPI, and Australia's actually isn't a particularly high weighting, I suppose, relative to, if you ask most people, regardless of whether they're renting or they have a mortgage, what's one of their biggest costs, it is, housing themselves. And to say, oh, that's only 6% of the CPI, seems like a low number.
Yeah. Well, I guess 30% of the population rents, so it's about a third. So a third of people facing skyrocketing costs. But part of that's also because part of the reason why it hasn't had a bigger impact yet is because the ABS's measure of rents is very lagged. So that measures overall rents. And I guess it's a bit like a bathtub. So if you've got a bathtub that's full and you're pouring heaps and heaps of water into it, which is the asking rents, like they're rocketing really quick, the bathtub fills slowly, but it still fills. And that's sort of where the CPI is at. Like the asking rents have rocketed way higher than the CPI rents, but CPI rents are following.
Yeah.
Which means
and it makes sense in terms of the way they're going. If you're renting, chances are, the fact that rents are up 20%, over whatever period over the last couple of months, you probably haven't had a rent rate rise yet. You got to wait till your rental thing comes up, and that's when the rents kick in and all that sort of stuff. So
it's always lagged. It's always lagged by about 12 months.
Yeah. So okay, so we've got that side of it. So there was immigration. Now we're obviously getting headlines full of bankruptcies for construction companies as well. So housing boom, rental boom, housing construction companies going under, and maybe we can talk a little bit about housing starts and apartment starts as well.
Yeah, so basically Australia's got this perverse situation where we've got almost a record pipeline of dwellings under construction, and the reason for that is so actual completions are quite low at the moment, but because of the home builder stimulus, which the Morrison government did, basically we had a huge rush of people coming in and sign those fixed price contracts to build houses. And then we got obviously the delays with all construction materials, labor, etc. And over the subsequent 2 years, we saw construction costs rocket. And basically we've got builders that are arguably busier than ever, losing more money than ever because they signed these fixed price contracts, costs that then skyrocketed, and they're all losing money because they've got fixed price contracts. And that's why we've seen players like Porter Davis Homes, etc., collapse. And Porter Davis had 1,500 homes under construction in Victoria. All of them were on fixed price contracts. And this is kind of going across the entire construction industry. And according to ASIC data, 1,500 home builders have collapsed, which is obviously, tiny players, whatever. And then you got the Porter Davises. In so far this financial year. So that's a bit of a concern. The other issue is so construction companies have collapsed. We've also got this record pipeline because of all these delays. There's all these homes that are sort of half built and they haven't been finished. And those should roll off over the next 12 months. So we'll still have decent additions to housing supply. Builders will be reasonably busy for the next 12 months, even if they're losing money. The big problem is that all the forward-looking indicators after that have collapsed. So new home sales have halved since the RBA increased rates. Dwelling approvals have tanked, and loans for new construction, which the ABS measures, are at the lowest level in history. So we've got this situation where we've got this record pipeline because of all of the delays. Builders are collapsing. These homes, most of them will eventually get built. But then after that, what happens? Because basically the new home demand that's been signed now and etc. has tanked. And this is at a time of when we've got, population growing by 500,000 people a year, and our supply side is completely bottlenecked. So all that to me means that rents are going to keep rising. We're going to have a shortage of homes, and that means that established house prices will probably it's going to put a rocket under established house prices because there's obviously less construction. People have to buy houses that are already built, and there's more people competing for them. That's I guess that's my view. And my view is the only thing holding back prices at the moment is interest rates and capacity and capacity to borrowing capacity, which have been restricted by high interest rates.
Yeah.
So
okay, sorry. And one other factor then, and then apartments. So So much longer lead times on those, and they all sort of died pre-pandemic in terms of the approvals.
Yeah, well, actually,
So
apartment construction peaked at about 2015. So sort of mid last decade, we had the peak in construction for apartments, and since then it's been quite low, and it's been it hasn't the apartment approvals have actually tanked as well. So it's it's a pretty diabolical.
They tanked sort of pre-pandemic, didn't they? Never really picked up.
Nah, that's right.
Yeah.
So they peaked in 2015. They sort of fell in the next few years leading up to the pandemic, and they just haven't picked up at all. So, which is a pity because that's kind of where the rents are actually rising the most at the moment, is in the apartment space, because we've got a flood of foreign students who tend to go to apartments. So that's just putting more pressure on the rental market as well. So it's kind of a diabolical situation. And I guess my view, the only thing holding back prices is at the moment is the fact that interest rates are high, borrowing capacity has been shrunk, and APRA has maintained its 3% mortgage buffer. So effectively, new people applying for a loan now are getting assessed at sort of 8.5% for a mortgage, because they've got to do 3% above the presiding interest rate. And so that means that's really shrunk borrowing capacity. And what I think is going to happen, this is, I mean, you might have a different view, but is the RBA is probably going to cut rates towards the end of this year. And then APRA has signaled that they want to cut the mortgage buffer. So the mortgage buffer made heaps of sense when we had, mortgage rates of 2%, but now it's risen that they make less sense to have 3% mortgage buffer if you're looking at it from from their perspective. So they've already signaled that they want to cut it. They just don't want to cut it now while the RBA is still in a hiking bias, and because then you're working against the central bank. But if the central bank cuts, APRA will probably come in over it and help it out by cutting the mortgage serviceability buffer from maybe 3% to 2%, and then that's just going to increase borrowing capacity. So it's a reason why I think there's going to be a firecracker under house prices next year because of these sorts of reasons.
Yeah. So and I guess exploring this further, because this is, I think, where the rubber hits the road, is that if you're looking at an economy something like what we're seeing today, provided that there's not a lot of provided we don't go into like a big recession, I guess that's sort of the baseline view. I think that's probably, I guess, what you're seeing from most economists is, provided there's not a big recession, provided this mortgage cliff doesn't really smash and force people to sell, then that's sort of the default is that everything else is sort of pointed up.
Yeah, but I don't think we're going to get a big takeoff until the RBA cuts. So like prices are rising at the moment; they're rising slowly. And then we've got the mortgage cliff that's happening right now, so that'll probably constrain it. But I think like the mortgage cliff will basically run its course pretty much by the end of the year. Almost all those, the mortgage cliff, most of it will be exhausted. So then if you've got, the RBA cutting, APRA cutting its mortgage serviceability buffer, you've still got rocket under immigration, rental markets super tight, and you've got obviously the construction, the supply side is completely bottlenecked because of all these builder failures, and cost of materials has still gone up. They went up 30% over the pandemic for building construction materials. So you're going to have reduced supply, more demand through financial demand, and also people. That to me points, rising prices. But of course, and the thing about it is, if Australia gets a bigger recession than would have expected, the RBA is probably going to cut harder. So you could actually get a bigger house price rebound. It just might be a little bit lagged. So I just think the factors are pointing to next year being a pretty strong price growth. I think fairly strong rebound, just because you're probably going to have all the a perfect storm, if you like. And also we've got foreign buyers coming back as well. So there's lots of reports out there of foreign buyer interest coming back as well from China, etc. So that's just another tailwind. Like, it's a minor one, but it all kind of adds up.
Yeah. The demand versus supply, so and the other demand, but I guess, I mean, the one which we haven't sort of touched on is this whole idea of the number of people per household. Sorry, you touched on it briefly at the start.
Yeah.
But that's I guess that's where that's to me where the big flex is as well, in terms of saying, okay, we've had this pandemic hit, huge cash splashes. The number of people per household's fallen. So more people living on their own, more people or with extra rooms, needing offices and all that type of stuff. And so that's created this big demand push. And now but at the same time, we've got whatever it is, 1 million, roughly 10% of houses are unoccupied, on the basis of second homes and apartment in the city and a house somewhere else and holiday homes and all that type of stuff. And so that's sort of an economic argument, isn't it, in terms of saying, well, if we go into a big recession, then there's lots of room for people to be selling second houses. There's lots of room for people to be getting extra flatmates and all that type of stuff. And sort of just going back to the rates, the sort of occupancy rates we had a few years ago would actually free up a lot of supply. So
it's some, because I think the estimates was the reduction in people per house added about 150,000 to
demand.
Well, I mean demand, or reduced 150,000 supply, but right. Which sounds it's a reasonable amount, but it's not huge when you've got population growing by 500,000. So it's like
but that would basically, though. I mean, it's what, 2 and a bit per household.
Yeah, two and a half-ish.
That would pretty much, that'd give you a year's worth of.
Yeah.
If you undid that, there's a year's worth of supply.
Yeah. Oh no, I would definitely take your point. Like I think that's going to happen anyway. It's going to have to happen because if you got rents rising at double-digit pace, and obviously cost of living pressures left, right, and centre, you will see the people per house rise. It's just inevitable. It's going to happen.
Yeah.
And it's interesting. So during the pandemic, it fell. But it only fell to around the level it was in 2008 before we embarked on this big immigration program. So basically, we brought in tons of people over 15 years that increased the number of people per house. And then we had the pandemic, and people left. So it went back down, and we're just going to go back up again. No doubt about it. Because it's just, they've got to live somewhere. And the affordability constraints, people will take on flatmates. They go, okay, well, I'm not going to have this home office anymore. I can't afford it. Kids will stay at home longer. That's another one. So you're gonna have adult kids living with their parents. All that sort of stuff. And the market is flexible in that way. And that's generally what happens during recessions anyway. Like if you go to US, here, anywhere, you get a rise in the number of people per house because people need to save money. It's inevitable.
And so could I guess where I'm leading to with this is, it would seem to me that the summary is, look, for 60 or 70% of household owners, things are probably going to be fine. You got some higher interest rates. You have to cut back a bit on your spending, but we've had not good wage growth, but it hasn't been terrible wage growth. And so they've got lots of buffers and all this type of stuff like that. And so they wash out all right. We've got this rump at the other end who's going to be facing higher mortgages because they're not getting the same discounts as everyone else. So
the mortgage prisoners, they call them.
Yeah.
The ones who come off, say, fixed rates, they can't refinance because they no longer meet the serviceability requirements, or they're in negative equity and they're stuck with their lender paying 6% when they could be paying 5%.
Well, I guess my point is, it might have, like I've been talking about discounted variable rates in terms of this. If they have to go to the standard variable rates because they just don't meet the criteria, then they're up 7% or more.
Well, it's funny because CanStar did some research about a month ago, and they said that about a quarter of mortgage holders are paying rates above 6%, and or maybe it was 6.5%. It was a really high figure, and I was just like, wow, that's actually pretty shocking.
Well, the standard variable rate that the RBA report for owner occupied at the moment is 8%.
Yeah.
So
I don't know anyone who pays that, but there would be, I guess, some.
Yeah. So whereas the discount rate they're reporting is 6.4.
Yeah, but even that's higher than what most people can get. But there's always those who are sort of the ones who go off their fixed rate loans. They automatically go to the standard. And if they don't meet the serviceability requirements, they're stuck as a mortgage prisoner on that. And they're the people that are really at risk. And I'm thinking mostly first home buyers that bought near the peak during the pandemic, who would have stretched themselves to get in.
Yeah.
Are going to be the ones in the most trouble.
And so I guess where I'm getting to with this is the issue is where to me the biggest risk to the view of that yes, houses are going to take off is that we don't know how many of these people there are. Well, sorry, we've got a rough guess of it, but are they forced to sell, or is it the fact that they can't? They're are these people looking, going, okay, well, even if I do sell, then I'm actually because rents have risen, I can't afford to rent anyway, so I may as well just hold on to this and stick with it.
Yeah.
Or are they just in the position where they've just got to, look, I've just got to sell because I don't have any other choice, and can't,
the bank sells
can't meet the payments. And yeah, exactly. The bank basically says, you're moving on. And that's where, you can see, I can certainly see a scenario where that gets out of control and prices start to fall, and you don't need, if you have to have 3 or 4% of people selling their house, that's enough to spark a really big reduction in prices. But the flip side is you've got all this other strength and probably and question marks over then how fast can the RBA cut rates if and when it decides to. But as you said, it's even if they don't cut rates and APRA says here's another 2%, that'll help for the people who are who might be thinking about buying their 3rd and 4th and 5th investment home, but it's not really going to help. Or I suppose that helps. It's not really going to help people who are getting out. If you know what I mean?
No. And that's what we don't know. And I reckon we'll know. We should have a really good idea at the end of by say July, because this is the quarter when we get the biggest spike in the fixed rate mortgage cliff. So it's this quarter is the biggest, and then the next 2 quarters are pretty big rollovers. But this is the big rollover right now, April, May, June. So I said before, so according to the Australian Bankers Association data, we had 70,000 fixed rate loans rolled off in the first quarter of this year. We get about 220,000. This is just across the big 4 banks, so it'd be a little bit higher across the system. But it goes from basically triple the number this quarter that we're currently in up until June. And then it's about 200,000 the next 2. So we should get a pretty good idea by July, I think, whether we're starting to see this impact.
I guess that's where I want to push back a little bit on that, is going, well, yeah, but so if you're struggling and you flip now and you flip to from a fixed to a variable, and you're at 8%, you've just gone from 2% to 8% because you're over your limits and that's what that's the rate you're being offered, and you can't escape, and you go, oh, I hope this gets better. Can I put my head in the sand for a little bit and see
how we go?
See how we go. And there's probably a couple of months of that before you've run up your credit card bills and all that type of stuff like that. And then it's oh shit, actually I am going to have to sell. And so then there's a few months of that. Let me dress the house up and put a paint over here and go through the sale process. I guess what I'm getting to is
could be delayed.
Yeah.
Absolutely. Yeah. But I reckon we would start to see it, you'd think, by mid-year, because you've got those 3 months and you've got the first 70,000 that rolled off in the first quarter. So we should start to at least see. So I guess one of the things I'm looking at is the distressed sales that like Louis Christopher reports.
Yes.
And there's been a little bit of a tick up, but not much. Like it's still very low levels. But if that starts to pick up pretty abruptly in the next few months, that's a pretty good sign that hang on, they could have. And if he's stock on market, so he does a release every month where he does he's called a stock on market release, and he does basically new listings, old listings, distressed sales, and he's got a distressed sales figure. So if you start seeing the new listings pick up alongside the distressed sales, that's probably a sign that hang on, this is starting to bite. But that's one of the things I'm looking at.
Yeah, so, and I'm not. I guess what I'm trying to say to people is, I think if we get to July and prices are flat or haven't gone much in either direction, I guess what I'm saying is, to me, that's not okay, great, where it's all signs to go now. I guess what I'm saying is, if you're listening to this going, okay, there's a chance for me to go out and buy something and get this upside. I guess the biggest thing I want to focus on is. Now there's this. It's a recessionary risk and the mortgage cliff. That's the thing that could blow up the entire story. As long as we make it through that, all right. Then I'm on board with the whole
and the RBA cuts.
And the RBA cut
and
quickly.
then APRA, I can just say, I think as soon as the RBA does do a cut, I can see APRA then doing the mortgage buffer, because they have gone in the media and suggested they want to do it. And then
Yes,
I remember there was a pushback at the time saying, well, why would you cut your mortgage buffer when the RBA is hiking? You're working against the central bank.
yeah.
But then, so it's just waiting to do it. Like, it's waiting to pull the trigger. And once the RBA basically green lights them, because it goes into an easing bias, APRA will then go into an easing bias with its mortgage buffer. And then you got borrowing capacity rise.
Yes,
But that's probably more a story for next year, really. Because I can't see much. I can't see the APRA cutting the mortgage buffer at all this year. Maybe November, December, maybe. But I could see the RBA maybe doing a cut towards the end of the year, and then APRA following, I don't know, early next year, and then we could be off to the races because we've still got all the other stuff happening.
Yeah, that's right, and that's the one I guess I'm. Look, Frank, I think there's it's a lot of this comes down to the question of, if we are headed for a recession, and it looks like it, it certainly looks like it on a bunch of different measures. Is it, how deep is it? Is it just a garden variety recession? In which case, look upon the next 6 to 12 months as a chance to pick these things up and go for it. If it turns into something a bit more, then yeah.
See, I don't know if Australia is actually going into recession. I think we're probably we're going to have a per capita recession, which is what we usually do. But when you got population growing at 2%, it's actually pretty hard to have one. Because we could eke out 0.5% of growth, which is garbage, on 2% population growth, and we're going backwards by 1.5%. But it won't be a recession, and that was Australia's story in the decades leading up to the pandemic.
Well, and the financial crisis. We managed to skirt recession, as everyone said, but not on a per capita basis. We were definitely there, but we just flooded the market with extra people, and so yeah.
Yeah, that's basically what Australia and I guess Canada's doing at the moment. So, anyway, but who knows, mate? Like, it's all, look, let's face it, it's all a bit of this one. Looking at a finger going, try and look at the drivers and stuff like that. But definitely the mortgage cliff is happening right now, is like when it started. Like, this is we're approaching the cliff, I guess, if you want to call it a cliff.
Yeah.
Well, it's more of a plateau, because it goes up and then it's high for about three quarters. So this quarter and the next two, it's pretty high. Yeah. And then by the end of the year, we're going to be almost through it. So if it doesn't kill us in the next 3 quarters, then, that'll be a pretty strong sign. But then again, it could kill us, but we just don't know.
Yeah, guys, we've had a couple of questions come through. So we've got a question from Michael James. He's asking, will there be a divergence in established and new home prices? And he's saying new build numbers seem to be down significantly, with the established home prices ticking up recently. And he's also got another comment: where will new immigrants go? So,
can I just say on the new home prices, I think they're actually going to go up quite a lot, because that's based more on the cost of construction. So construction costs have gone up 30% in the last 2 years. So, and I know, because I've got a mate. I've got 2 mates who are building the same kind of house in the same suburb, and one of them was lucky enough to have his house finish about a year ago. Another one is trying to build almost the same sort of house a street away right now. And mate, there's like a 300 grand difference between what they're both paying, and they already own the block, so they're doing a demo and rebuild, and it's purely because the costs have rocketed. So I think new home prices are going to go up because of the cost of construction, and I think we can kiss goodbye to fixed price contracts. It's going to be a lot riskier now if you want to build, because you're not going to be able to just lock in a price and go, okay, that's my budget, I'm locked in this price. They're now going to be, there's going to be ratchet up clauses now. So I think that's a problem. So the price of new builds is the cost of land, and obviously the building, and the building part of that's going to go up a lot. And the way the developers, manipulate the land market, I can't see really land costs falling much, especially when you got, big population growth. So they'll continue to choke supply as they always do.
Okay, nice one. We've just got a quick message. We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show. Great. So we've also had a couple of questions come through around the RBA review that hit the news today. Damo, have you got any thoughts on how this is going to impact this whole sort of housing situation?
Yeah, well, actually, do you want to hit the questions? Let's hit the questions and we can talk.
Sure.
Talk briefly about it.
So Wolf was saying the new board to give cabinet sneak control of interest rates looks sinister. Could be a disaster if recession hits. Your thoughts on effects of housing and bonds, and the other ones. I wonder how the RBA review has hit the news today will impact this.
Yeah, I feel like the independent side's still relatively secure. I mean, I've skim read it, so I was out this morning and preparing for a podcast and everything. So I've skim read it. Yeah, my initial impressions was yes, there wasn't heaps of groundbreaking things in it. There was lots of small changes. I think there's there probably wasn't as much focus as we would have liked on the whole. You kept rates far too long for a decade. They were far too high for a decade, and had wage growth, particularly low. There's a lot more about external, and I think that's probably a good thing for the RBA. I think there's within the RBA, it's been a relatively closed shop for a long time, and yes, they've got this board that oversees them with external members, but the external members haven't been monetary policy experts. They've been basically people from industry, and I think it's very hard for a person from industry to comprehensively argue with a central bank that's, I think, probably has a reasonable amount of groupthink within it. And so I think the changes at the margin will probably help in terms of that. Getting more sort of accountability. A number of the changes sort of help to line us up with what's happening overseas, but it's not the changes I've seen so far, and the changes I've seen as I've read it, sort of says that this is going to be, maybe you'd call it like an evolutionary change, not a revolutionary change. And it's hard to say, would this have changed a lot about what the RBA would have done in recent years? Probably not heaps. So I guess I don't think it is a sneak reassertion of control by cabinet. I guess I could go into a long part about, would that be such a bad thing if it was? I sort of, in a way, there's this issue we've got where we've got the government of the day who's running fiscal policy, and the RBA that's running monetary policy. And we one of the big problems we had through the 2010s was that they were basically running it in opposite. Like we've got the RBA trying to get demand up and get inflation up to its target and get wage growth up, and you've got a government looking for surpluses. And so, and the government can just blame stuff on the RBA if it doesn't go right. So, in a way, it wouldn't particularly bother me if you saw that, governments, this is your job to make sure the economy is running properly. But yeah, that's my read of it. Wasn't that was what was going to happen. Any other questions on?
None on the RBA review, but we've got some other ones. I've got one from Andy Reid asking for thoughts on credit destruction scenario as mortgage holders start paying down debt faster.
Yeah, well, I mean, that's not as much of an issue in Australia as what it is overseas. And I guess why I'm saying that is because, let's say you take the US as a good example, is you do the 30-year mortgages, and then that sort of, when that pays out early, that's sort of there's an interest rate issue there that there's people who are looking for the 30-year rate and are not getting it and things like that. For Australia, that's not as much of an issue. I think there's I guess for me, the credit creation side is probably the bigger part, and that's where, as Leith was saying, if we get interest rate cuts, then there's lots of Australians prepared to borrow and prepared to borrow for houses, and so and if that means that this is people getting their third, fourth, fifth, sixth house, then that's where, if you picked a small proportion of the population and said 3% of people run into trouble because they can't afford their mortgages anymore. But on the flip side, we've just opened up for 50% of the population to be able to borrow heaps more and negative gear and do whatever it is. Then of that 50%, of a small proportion of that's enough to buy the 2 or 3% of people who ran into problems, then you don't have a housing crisis. But if they don't have the extra capacity, then you can start to see prices starting to fall. And if prices start to fall, then maybe people start to think about, well, do I buy a house now or do I just wait? And that's where that can become a bit self-reinforcing. So as with all these things, it's a sentiment does drive a big part at the margin. I think it's very hard to make economic arguments for why house prices should be higher in terms of returns and returns excluding tax benefits and all these other factors. But when you take into account psyches and views on house prices always go up and people wanting to get tax deductions and all these other factors, and then I think that you can get scenarios that Leith has been talking about where we see a groundswell of factors all moving in the right direction, and lack of supply with record amounts of people coming through.
Yeah, and part of the reason is because, not just heaps of people coming in, but renting is very unattractive in this country. So, it's like, who wants to be stuck in the rental market when you can be kicked out every 12 months? You got your rental rates are rocketing. So there's this incentive to always people to not rent because it's not great. Like, we don't have great tenancy laws here. We don't have long-term rentals. It's just not a very good situation. So, once you add heaps of people into the mix and you make the rental market even less attractive, a lot of them are going to just go, stuff it, I'm going to borrow big, so I never have to do this again. And then they're basically renting from the bank anyway, but at least they renting long-term from the bank.
Yes.
Yeah, we've got a couple more questions, but I think we'll address them after the investment implications. So we're just going to go to the question of the week now, and this is for viewers to have some discussion in the comment section over the coming days. And the question for this week is: has the housing bust got further to go, or are we in for another boom? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. So back to you guys for the investment implications.
Yeah, sure. I might hand across to you, Leith, for the housing outlook for 2024.
Yeah. So look, my view is take it or leave it. Is that next year is going to be pretty strong for the housing market. So by the end of this year, we're going to be through most of the fixed rate mortgage cliff. So that will have rolled off. It'll either go benignly or it'll go badly. If it goes badly, we'll get another little leg down in house prices. It also probably means that the economy will weaken more and the RBA will come through with a bit deeper rate cuts. I think regardless, the RBA is going to cut rates anyway towards the end of the year. And for reasons said earlier, I think APRA is going to then come over the top and cut the mortgage serviceability buffer from, say, 3% to 2% or maybe 1.5%, because we'll be up near the peak of the interest rate cycle and they're not so worried about people taking out, mortgages at ultra cheap rates that they can't afford because rates will be coming down. That'll increase borrowing capacity and obviously mortgage demand. We've got obviously the highest immigration in history, the worst rental market in my lifetime anyway. I'm 45 years old. It might have been worse before me. Don't know. And then we've got pick up in foreign buyer demand. So I think all the and obviously the supply side's completely stuffed, owing to builder collapses and rises in material costs, etc. So. Which just puts more pressure on the established housing market, which more people got way more people competing for a sort of almost a fixed number of homes. So I think next year we're going to get pretty strong house price growth. I can't put a percentage figure. I got no idea. I just think it's going to be decent, like a pretty solid year of growth. Maybe, I don't know. I'll pull it out of thin air, 10%. Like that's nothing better than the pre-COVID, the pandemic experience, but a pretty decent house price rebound.
Just to highlight as well, that'll put depending upon what interest rates do, but that'll have affordability. Maybe not twice as bad as it's ever been, but it'll be 50% higher, worse than it's ever been. And now if you pull back interest rates by a decent chunk, you start to get affordability just at record highs.
Yeah, basically, that's right. So basically, the worst it was in 2008 when you look at mortgage payments to income. So that's principal and interest, and we're going to, according to the RBA, even if they don't raise again with the fixed rate mortgage cliff, we're going to be up above that by the end of the year. And if they cut a little bit and prices go up, we're going to be sort of stuck at that horrible level. Anyway.
And I guess the only other thing to factor in is that we've spoken a little bit about the tax regime and I guess sort of policies in terms of what policies could be put in to actually go and fix some of these issues, and whether it be public funding of more rental properties or low income or a whole bunch of other factors, whether it be removing things like negative gearing or extra support for developers, or a whole bunch of factors you could say that would actually help in terms of land taxes and all these other things that could provide some help. None of them are being mooted or suggested, and it would be to me, it would be highly unlikely for this government to change its view and to put through any of those, given their sort of they lost the last election on how. Sorry, they lost two elections ago. They lost it on housing issues. They don't seem to want to do a hell of a lot. So I guess there doesn't seem to be a lot coming on the regulatory front that could help. I guess one possible thing on the money laundering side, we spoke a few months ago about that with
Nathan Lynch,
who seemed relatively optimistic. I think I expressed my skepticism at the time. My gut feel still is that they won't do anything on the money laundering.
Yeah, or if they do, it'll be so dragged out that it's not going to impact the next cycle. So they could say by 2025, we've got to have all these checks done.
Yeah.
And
then they'll move it to 2028.
Yeah, of course.
2030, and then they'll.
That's straight. But to Damo's point, pretty much all interventions by the government to fix affordability actually make it worse. So it's usually, first home buyers grants, stamp duty concessions, something which increases borrowing capacity, and it adds more, fuel to the fire which actually raises prices, because that's electorally popular. And even on the supply side, whenever the developers say they want this and that done, it's usually to line their own pockets rather than actually, improve the situation. So don't expect much from the policy front, I don't think.
Yeah, the one thing that could happen on the money laundering side, or the best possible outcome, the most optimistic you'd have to be on that front is that actually other countries turn around and say, that's it, we're sick of Australia, so money laundering property through crime, proceeds of crime through property, and we're going to force Australia to do it. But again, there's not a lot on that front that I can see going on. Okay, so that's sort of your rough outlook on houses, but I want to sort of overlay that with this view that, look, there is it's a little bit of a binary outcome, and it's like, yes, okay, as long as we skirt recession, or we go into recession that's quite mild and that doesn't affect and we get some interest rate cuts within a reasonable order, then you can get that bullish view. There is another significant leg down view, though, that things get out of control, and the mortgage cliff, coincides with a bunch of bankruptcies, coincides with global recessions and demand taking this big hit all at the same time. And so it's not without risks, I guess.
No.
And it's I just want to highlight that from an investment perspective, the way we're looking at it is very much to try and line those up and to take into account that, look, if it gets out of control and there's a reasonable probability that it does, then there's further downside, and you need to sort of protect look for protection first before looking for the opportunity.
Awesome. So we do have a question from Andy R. You've sort of touched on it just then, Damo, but he's asking, is the tactical growth portfolio geared to take advantage of this housing boom next year, or is there more growth in companies and bonds?
No, it's not. Look, I think there's, from our investment perspective, it's we're more concerned about things getting worse before they get better. So you need to come up with an argument within this for the RBA to be cutting rates, and so for that you need to be seeing slowing, quite significantly slowing in terms of inflation, and so there's the question about what is it that brings that about, and is that factor, so it needs to be negative economic news, and is that negative economic news bad enough that the RBA will then start cutting rates? And so, that's the push-pull at the moment. And so, for me, it's about saying, look, we can have this. I think it's a reasonable view that if we have a mild recession, and the economic fallout is sort of limited more in not in terms of big declines in houses, and more about other sectors of the economy, that we could see the RBA cut rates and this benign outcome. But the risk is that what does cause it is we hit the mortgage cliff, unemployment starts to jump, the rest of the world starts slowing quickly, commodity prices start falling at the same time, and we see we see things get a lot worse before you start seeing the rate cuts. And so I guess it's a question of timing. Obviously, house prices and buying houses is not the same as buying shares. You can buy shares and you can be all done in a few minutes. Houses take a lot longer in terms of the process, and so it's much easier in terms of shares to hold back and wait and have a longer term. And wait to see how things unfold before you actually jump in and make these purchases.
Awesome. And I just want to let all the viewers know, depending on your outlook of what's going to happen, across all our portfolios, we do have screens and tilts. So companies you can knock out of your portfolio depending on your views, or companies that you can actually add into your portfolio. So a way, some clients could take advantage of, if you're bearish on the Australian property market, we've got a screen where you can remove the Aussie banks or limit Australian housing exposure. And then on the other side of the coin, if you're bullish, if you think we're not going to have a recession and things are going to take off, you can add in growth stocks, for example, or global financials, or large tech stocks. And we're just going to jump to a quick message just explaining about that in a little more detail. We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show. Okay, so we're back, and that pretty much wraps up our episode today. So just want to say thanks, Leith. Thanks for coming on again. Always great insights, and a pleasure to have you on the show.
No worries, mate. Anytime.
Excellent. And Damo, as always, great insights. And we're all looking forward to next week.
Thanks, Sam.
Nice one. If you enjoy our content, you can subscribe to our YouTube channel now. Click the bell below to make sure you don't miss out on any special episodes and future content. And we do put out a lot of other content in addition to this podcast. We're always writing articles and looking for other ways to add value to our subscribers and listeners. If you want to have a look at the slides in more detail this afternoon, we always put these up in the show notes, and you can have a look at them at nucleuswealth.com/webinars. Like the video now, and if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you please share it with them. We do welcome your feedback on this podcast, and especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comments section below, or send us an email at contact@nucleuswealth.com. If you'd like to look at the slides in more detail, I've already covered that, so won't repeat that. But just want to say from myself, Damien, Leith, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next week. Bye for now.